Welcome back to Financial Freedom FX. Today, we're decoding a powerful market manipulation pattern known as the fake breakdown setup. On the surface, this might look like a typical bearish breakout, but hidden inside is a trap for impatient sellers. Understanding this setup can save you from losses and help you catch strong reversals early. Let's dive into this chart and explore every detail step by step. Starting from the left, we see a clear downtrend in price action. Lower highs, LH, and lower lows, LL, dominate the chart. This is confirmed by the zigzag diagram at the bottom left corner. The trend line is drawn across the swing highs, acting as descending resistance. Sellers are in control at this stage, and the market appears to be respecting this trend line perfectly, bouncing off it multiple times. The bearish sentiment seems strong. Eventually, price arrives at a key horizontal support zone. This level has been tested multiple times in the past, making it a strong demand area. Suddenly, price breaks below this support zone. This is where the term fake breakdown comes in. To most traders, this looks like a genuine breakout to the downside, but it's a trap. Smart money uses this moment to induce panic selling, drawing in retail shorts just before reversing the price aggressively. Right after the fake breakdown, price quickly reclaims the support zone and starts climbing. This reclaim is the first sign that the breakdown was false. Then, something even more important happens. Price breaks above the trendline resistance. This break invalidates the entire bearish structure, shifting market momentum from bearish to bullish. This dual signal, reclaiming support and breaking trendline, gives a strong confluence for a long entry. Once the price breaks the trendline, it rallies aggressively. Buyers who recognize the trap early are rewarded. The green box on the chart shows the target area reaching all the way up to the previous resistance zone. This explosive bullish move confirms the power of this setup. The red box marks the invalidation area or stop loss zone just below the reclaimed support. Risk is minimal, but reward potential is massive. This setup is a classic example of smart money manipulation. They create the illusion of a breakdown to collect liquidity from trapped sellers. Retail traders who short the fake breakdown provide the fuel for the bullish move when they exit their trades. By understanding how institutional players move the market, we can align ourselves with their strategy instead of falling victim to it. The lower left corner diagram shows a textbook shift in market structure. First, the chart prints LL, lower lows, and LH, lower highs. But after the fake breakdown, the market breaks above the previous lower high, indicating a potential bullish market structure shift. This is often the earliest signal that the trend might be reversing, especially when combined with a trap like this. Traders should always be cautious around key support zones. If a breakdown happens too quickly and is immediately followed by a strong bullish engulfing move or trendline breakout, it's often a sign of a fake out. Wait for confirmation, look for liquidity grabs, reclaim of key zones, and structure shifts before entering a trade. That's how professional traders approach the market. In real markets, fake breakdowns happen frequently, especially around news events or during low-volume periods. Learning to spot these traps can significantly improve your win rate. Always ask yourself, who is getting trapped here and why? When you think like smart money, you stop trading blindly and start trading with intention and clarity. This chart is a textbook representation of liquidity engineering, order blocks, supply and demand zones, BOS, break of structure, and internal market behavior, IMB. If you want to master institutional level trading, stay tuned as we decode each zone, move, and manipulation step by step. We begin at the far left where price taps into a strong bullish order block, OB, marked at the bottom. This OB acts as a foundational demand zone, and it's located just above the liquidity buyer's stop-loss zone, a critical area where institutions typically trigger retail stop-losses to grab liquidity before reversing the market. This sweep of liquidity fuels the strong upward move that follows. After tapping the order block, price aggressively rallies, leaving behind an IMB, internal market behavior gap, signaling institutional imbalance or inefficiency. These gaps often act as magnets for price later. The rally breaks above short-term resistance, forming a support zone which price respects in its upward structure. Notice how this support aligns with the previous order block, classic SMC confluence. As the price moves higher, it encounters a resistance support flip zone, RS, a horizontal level where previous resistance becomes support. This zone is later used again by institutions for reaction-based trades. It also becomes the anchor for the support trend line, seen cutting across the bullish structure. This trend line adds a diagonal support structure under the rising candles. At the top of the bullish structure, a supply zone is formed, just above the 5-minute order block, OB. Price starts consolidating, creating the illusion of strength. This is a trap. Smart money uses the support trend line as bait, making traders believe the trend will continue. Suddenly, price breaks below both the trend line and the 5-minute OB, leading to a sharp break of structure, BOS, confirming that bulls have lost control. The BOS acts as the major turning point. It marks the moment when the bullish structure officially collapses. Traders who entered late longs near the top get trapped. Price drops sharply into the demand zone located just below, which aligns with a previous imbalance, IMB and untested support area. The demand zone temporarily holds the price, offering a pullback opportunity for smart money to redistribute. We also see Fibonacci retracement levels plotted on the chart, targeting the golden ratio, 0.618 zone. These levels align perfectly with price reactions around the 5-minute OB and previous minor resistance. This reinforces the idea that institutions are targeting high-probability confluences, not just arbitrary levels. Despite the bounce from the demand zone, price fails to create a higher high. Instead, it forms a lower high, confirming a downtrend. It returns to the previous IMB area, fills the inefficiency, and resumes the downward movement. This shows institutional intent. They are mitigating previous positions and continuing the distribution phase. In the final phase of the chart, price crashes through the earlier support zone and approaches the liquidity buyer's stop-loss zone once again. This deep sweep takes out remaining buy-side liquidity before possibly reversing or creating a new structure. Also notice multiple SS markers, structure shift, indicating micro-level structure breaks within the larger move. And that wraps up our deep dive into the most powerful tools of multi-time frame analysis. If you're serious about leveling up your trading, remember this. It's not about chasing signals. It's about understanding structure, timeframes, and smart money intent. Mastering these tools will help you stop overtrading and start executing like a pro. If you found value in this breakdown, don't forget to hit the like button, comment below which tool you're already using, and subscribe to Financial Freedom FX for more advanced strategies and real-time chart breakdowns. This is where real traders grow, and your journey to consistent profits starts here. See you in the next video.